This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, the president just ordered the banks to do the unthinkable, and you're not going to believe what he just told the banks to do. But before we get to that, we have some breaking news about the U.S. economy, as now we can prove that the labor market is nowhere near as strong as the political elites want us to believe. And with that, let's head over to Bloomberg, where we picked today's story up with a headline: the U.S. job openings fall to the lowest since 2021 in broad cool down. And this is something we suggested would happen on this show, because what we've seen from the regional Fed surveys, from the ISM Purchasing Managers Index on both the manufacturing and services side, the demand was starting to weaken. And one of the first signs of that is employers would pull the job openings. Now, we don't see that in those surveys. What we see in them is hours of work getting trimmed and headcount starting to go. Of course, the obvious sign now is the labor market is going to see the bottom fall out, as employers just don't need as many workers. The evidence here in the JOLT survey, as available positions decreased to 8.06 million from downwardly revised 8.36 million reading in the prior month, according to the Bureau of Labor Statistics. And what's interesting about the JOLT survey, former Fed Chair Janet Yellen, this was her favorite data series. Well, I'll give you some reasons why. The vacancies figure was below all estimates, as everyone believed the labor market is actually stronger than it actually is. The pullback was fairly broad, led by declines in healthcare and government. Openings in accommodation and food services also decreased, possibly reflecting California's higher minimum wage requirements, or perhaps suggesting that the economy, as we've talked about in the recent shows, is running out of money, and that means the purchasing power of consumers is declining along with demand. And if demand goes, well, you certainly don't need that many employees. And here we can see the job openings and labor turnover survey shown in blue against continued unemployment claims. And if you're looking at the two and say, well, they look somewhat like a mirror of each other, you've got that right, suggesting that either the continued unemployment claims data is wrong, which I don't believe is the case, that we think the real truth is a lot of people are probably on severance packages, and as those run out, well, what it means is we're going to see continued claims start to go up along with initial claims, as we continue to see a further degradation in the number of job openings. And recent data indicates the labor market is cooling, but it's been gradual through slower hiring rather than outright job cuts. The Federal Reserve officials hope that the trend will continue in order to rein in demand and tame inflation without putting millions of people out of work. But the reality is it's going to put millions of people out of work. But if you're looking to get an edge on everyone else, well, you can. If you see headlines like this, the first crop conditions report keeps pressure on grain prices, and wondering, how did I not know to buy this? Could I have done that? Well, we told our subscribers right down here when to buy this, and now they're up big. We're talking as of close of business yesterday, up 21 and 20% relative, depending on which report and trades they took. Now, how do we do this? We take a look at the machine positioning every day, and we look for machines that are deep short on a position and then price rallying against them. We alert our subscribers. They have a fully downloaded report. We even put out videos to show them the trade. And then maybe you don't want to beat the machines, even though we can show you how to do that. Maybe you're a technical trader. We have our Momentum Timer Pro report that looks at all those technical signals, aggregates them together, runs a proprietary overlay. We give you the best signals that come out and a video on how to trade it. We change the game. This is why so many of our subscribers are making money trading when they never have made money before, and now you can too. We back that up with a 30-day free trial. Links in the description below. Start making some extra money, because the economy isn't going to be doing it for you. As we look at the job openings now against the consumer price index, that's shown in red on a year-over-year rate of change. And what do we see here? That indeed, there's a reason Janet Yellen liked this so much, is because when job openings go down, well, it means demand for labor is going down. And if demand for labor is going down, that means the business is actually seeing demand weaken. When that happens, of course, inflation comes down, as we can see here, following the red line lower. And now everyone still believes that inflation is likely to surge higher. The JOLT survey says, well, not a chance of that happening. And that means, of course, risk for the broad equity market as we now look at the job openings and labor turnover survey still in blue against the NASDAQ 100. And many people believe that we're still in the early stages of a roaring bull market and that you got to be in it to win it. Well, the reality is the JOLT survey, and you can see the relationship here, is telling those in the equity market the economy is indeed going the wrong way. And something we flagged to our subscribers the other day, and we talked about on Sunday's show, is the potential in the bond market. When you look at interest rates, again, everyone still believes that interest rates need to go higher, that there's a relationship to the labor market and yields, and it makes sense if demand is going down and you're seeing fewer people needed by the workforce. Well, that means you need to see rates fall to spur consumption. Right now, the market believes rates still need to go higher. Labor markets say, no, we're going to be heading the other way. And you start to wonder why the U.S. economy is about to fall apart. Is because the financial conditions are too tight, rates are too high, and demand is plummeting. By the time the Fed figures this out, it'll be way too late. But now let's turn our attention because the president has now ordered the banks to do the unthinkable. And with that, we head over to China because they're ramping up their warning on bond buying frenzy with the PBOC. Of course, we know Xi Jinping pulling the strings here, selling in focus, now telling the banks that they've given them the strongest warning yet against overheating in the government bond market. If you can imagine this, you would think there's not a government in the world that wouldn't want lower interest rates to spur consumption. Now, we know that China's economy is weak. They're seeing deflation. They're seeing producer prices start to fall and further into deflation. They have a problem with their factory sector. There just isn't demand. They're trying to dump products all over the world. Their housing market's in shambles. And here you see the government saying and issuing a warning to the banks, you better not be selling these bonds. We need to see rates go higher. Instead, you got to stop buying them. A paper backed by the PBOC said the Monetary Authority is ready to sell more of them if needed and suggested a regional range for the 10-year yield should be 2.5% to 3%. Could you imagine if the U.S. government came out and told the market what it thought rates should be? That would, of course, just send ripples through the markets. But what we're seeing here is they believe that if they put more supply on the market, that means rates will go up. That's not the answer here. The real question is, why are banks buying bonds? Well, it's simple. They'd rather do that than lend. Can't blame them, as the PBOC's repeated warnings against what it deems as excessively low yields have largely been shrugged off by investors. Unconvinced by China's economic recovery and housing rescue plan, bond bulls have been betting the central bank will have to do more, such as lowering interest rates and even turning to the controversial step of quantitative easing. And it makes perfect sense. And we're likely to see this at some point in the U.S. as the bond market will likely take off ahead of a Fed rate cut, because in the case of China, they can't even generate enough domestic demand to stimulate their economy. And what we're seeing is interest rates go down. And part of this is the PBOC and the powers that be at Beijing do not understand how the bond market works. In fact, most people don't. It's a function. If you look at long-term yields of economic growth and inflation, both in China are headed down. That means yields need to fall to spur demand. And in the U.S., let's take a look at, we have the yield, 10-year Treasury yield. And just to show you this relationship, I took the Consumer Price Index and averaged it with the gross domestic product. That's shown in blue on a year-over-year rate of change. And you notice the relative consistent relationship that yields have with growth and inflation expectations. But right now, the market says no, rates have to go higher. The Fed says, yes, we agree, rates must go higher. The economy slowing down, looking like a massive train wreck coming to the U.S. and other economies all around the world, as investors may have to take it more seriously this time, as the PBOC has every reason to be concerned over falling interest rates. While cheaper borrowing costs have benefits, a yawning yield gap with the U.S. is adding pressure on the yuan and fueling bearish sentiment toward Chinese assets. And so that's the issue here, is Beijing's afraid of capital outflows because of a yield mismatch. The question is, what is worse, seeing your money flow out or your economy crash? It's a dangerous game, which is why these monetary authorities, these central elites, they have no clue what they're doing. They think they do, but in the end, they end up destroying economies more often than not. as the central bank may want to root out expectations of aggressive monetary easing, as such speculations have led to an influx of money into the bond market, draining bank deposits and funds available for the real economy. The reality is the banks don't see any opportunity to lend. And you start to look at the Chinese economy. We talked about the housing market, but look at the factory activity. It unexpectedly contracted, with the official manufacturing purchasers managing index falling to 49.5, which is effectively stall speed under slight contraction. The non-manufacturing gauge also flashed a warning with slower than expected expansion. And what this suggests is persistent demand weakness may also be starting to erode production strength, and this according to Citibank analysts. And yes, it means that China's economy is in trouble. It means that rates are too high. That's what the bond market is trying to tell Beijing. They're not listening. They believe it's all about the banks. That's why they're ordering them to stop buying bonds, if you could only imagine. But we talk about, of course, manufacturing sector here and why it's so key, because if you see a decline in demand in a debt-based economy, it tells you the cost of money is too high. And here you can see, looking at the Philly Fed General Business Activity Index, you can note that back in the 70s and 80s, the economy was a little bit different than it is now, and you can notice that rates rose as economic activity crashed. And what happened? We had a recession, then we had another one, and a double one there in the early 80s, suggesting that that's what we're on path for now, because we're repeating the same mistake we made then. And then you look as we get more into a global economy, we see slowdowns in the manufacturing sector, mean yields drop, and we see that relationship over and over. This time it's different. We now know the manufacturing sector is slowing down, as we had the data yesterday to validate it. And what this suggests is interest rates, not just in China and not just in the US, but all over the world, are way too high, and the demand is about to come crashing down faster than anyone thinks. And who else thinks demand's crashing? Well, hedge funds, as they dump Chinese stocks at the fastest pace in almost a year, looking to get out before, well, things get worse. And this is something that Zero Hedge noted to their subscribers. Of course, we also told people when to buy based on our reports. You may remember that trade from months ago. We flagged that and gave our subscribers a huge opportunity to make money. But then you start to maybe look at the other reason: there's going to be a global trade war. And why would that happen? Well, here's the problem. We all of a sudden have a lack of supply and or lack of demand, that is, and way too much supply. As China steps up warning the EU days before tariff decision, and if the EU does not practice what it preaches and continues to suppress Chinese companies, China will take all necessary measures to firmly safeguard the legitimate interests of Chinese companies. And so all of a sudden, hedge funds are starting to realize that if China can't unload all of its excess production on the rest of the world, well, stock prices are about to come crumbling down. And the EU has used overcapacity, unfair competition, and all their false narratives. The key one, overcapacity. Everyone's going to be facing that, to launch investigation into Chinese EVs, railway, solar, medical equipment, and other sectors, increasing the risk of China-EU frictions. There's going to be frictions among every major country, and the simple reason is everyone's going to try to protect their labor market. The problem is we went from way too much demand and not enough supply to suddenly we're going to have way too much supply and nowhere near enough demand. And even, of course, the headlines are trying to spin this in a positive factor, as Asia's factories sustain momentum as Japan halts an 11-month slump. The manufacturing purchases manager index for South Korea and Japan returned to growth, although very slightly, halting months of a slump. The gauge for Japan turned positive for the first time since May of 2023, while Korea returned to expansion after below 50 readings for 2 months. But look at this. How about Taiwan? Their index improved to 50.9. Remember, 50 is a gauge where you're in fact not changed from the month before. So 50.9 is virtually slightly unchanged from the month before, but everyone is looking for good news. Of course, the prior month, Taiwan was at 50.2, while the index for Vietnam sustained momentum, staying above the 50 level for now. Again, another month. And the latest set of data signals a broadly improving outlook for manufacturers on strength of new orders, despite signs of risk to China's recovery and lingering weakness in demand for goods. But what happens if the U.S. labor market goes? And that's what we're seeing here. Demand from all these export nations is going to outright plummet, which is why we're seeing oil all of a sudden the bottom fall out from that as oil prices slide after OPEC Plus plan spurs concern about a glut. And of course, when you don't have demand, and everyone believed that the U.S. economy was booming and was going to come out of the second half roaring, and that's why you saw these long positions built up in oil. And we warned that the economy was far weaker than anyone thought. And now the oil market's reacting as Brent fell as much as 2% below 77 a barrel. And get this, West Texas Intermediate, that of course we know OPEC needs at least at 80, if not higher, change hands at about 72.50. OPEC Plus alliance is scheduled to start unwinding output cuts as early as October, despite persistent concerns around demand outlook and robust supply outside the group. The real issue here is demand is crumbling down and the market is starting to wake up to it. In fact, we can look at that job openings and labor turnover survey against crude oil prices, and we can see where job openings go. Well, eventually oil follows. It's all a sign that the global economy and the U.S. labor market is far worse than the political elites want to believe. And that's why, of course, we see President Xi Jinping ordering the PBOC to do the unthinkable with banks, not even realizing how the monetary system works. But it won't matter. It won't be long before the Fed's cutting along with everyone else. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.